Good afternoon, ladies and gentlemen. Welcome to the MICROLISE Group PLC investor presentation for the full year results ended 30th of June 2021. Throughout the presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and will publish responses where it's appropriate to do so. These will be available via your Investor Meet company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you this presentation is being recorded, and before we begin, we'd like to submit the following poll. I'd now like to hand you over to Nadeem Raza, CEO, and Bill Wine, CFO of MICROLISE Group PLC. Good afternoon.
Hi, thank you very much for having us this afternoon, and thanks to the audience for their time. Just a quick introduction. So my name is Nadeem Raza. I'm the CEO for MICROLISE Group. I've been with the business since the late 80s, and my background is technology. I started life as a software engineer, went on to run our research and development department, became technical director, and then CEO when we did a management buyout in 2008. During the last 30 or so years, though, I've also run our manufacturing division, as well as our sales and marketing, our customer services, and our professional services division as well. So I've got a very good insight across the whole business. The only part of the business that I've not been directly managing at any point during that time is finance, and I'll hand across to Bill because that's where he comes in.
Good afternoon. My name's Bill Wynn. I'm the CFO of MICROLISE. I joined in 2007 to help Nadeem successfully conclude the management buyout, which we did. I've got a lot of experience of being CFO, over 30 years at board level, primarily in private companies, but several of those have been BP backed, and most of them have been software companies. So that working with PE backed companies has enabled me to bring a lot of M&A experience to MICROLISE as well.
Thanks, Bill. And we're just going to give you a few slides just to give you an introduction to MICROLISE before we get on to actually talking about some of the results that we've recently announced. So we're a provider of transport management solutions to large enterprise customers. So essentially, we provide software and hardware, although we classify ourselves as a software business, and we supply that to companies that run large fleets of vehicles, particularly heavy goods vehicles. And in the UK, in that large fleet sector of fleets above 500 vehicles, we really dominate that space. We have a 58% market share. And in the next segment down from 250 to 500 vehicles, we have a 46% market share. So, we really have a lot of great enterprise customers, and in particular segments, industry segments. So, for example, in retail and groceries, we have an 88% market share. So, we cover a lot of different industries, from retail, pharmaceuticals, construction, and so on. But in retail, we particularly dominate. So those are customers like Tesco, Sainsbury's, Asda, Morrisons. In fact, all of the top 15 retailers in the UK are our customers. And the kind of benefits that we deliver are cost savings. We help them become more efficient. We also help them reduce their greenhouse gas emissions as well. We have a range of offerings, and they're very modular, and we'll cover that in a couple of slides' time. But we have a very low churn rate. So once customers buy into our portfolio, they stick with us for quite a long time. We have some of those customers have been with us for 10, 15, 20 years. In fact, the customer that's been with us for the longest has been with us since the late 80s. So we benefit from that very low churn rate, and also our contracts are generally 5 years long. So we have great visibility into the future of incoming revenue as well. A couple of just highlights. We've been around since 82. We've always been owner managed. We've never had any private equity or VC input, and obviously we now IPO'd onto AIM as of late July. We have around 600 staff around the world, 4 offices, and about 400 of those large enterprise customers. We have lots of smaller customers as well, in fact, hundreds and thousands of smaller customers, but that enterprise space is where we have our sweet spot, and that's where we generally do a lot of our business. Our results that we've just posted for the period 1st of July through to the end of June 2021, so that 12-month period, revenue was up 57 million, and our SaaS recurring part of that revenue was 35.1 million. We also invest a lot in research and development, and that has meant we've won quite a few awards, including 3 Queen's Awards for Enterprise, 2 for innovation, and 1 of those was for international exports. We have a clear growth strategy, and we'll come on to that later on in the presentation. And as I mentioned, we IPO'd in July this year, and as part of that, we raised 18.6 million of primary capital to help us fund future growth. A little bit more about the products and services that we offer. So we produce a lot of different modules, but we categorize them into these 6 groups. So starting from the left, we have a fleet performance group of software, and here things that you will be very familiar with. It's tracking and telematics, so actually getting data about where the vehicle is. But our telematics is actually on steroids compared to a lot of the competition. We gather enormous amounts of information from the engine management system, as well as other sensors that we put onto the vehicles. The next group is fleet compliance, and here this is a portfolio that we acquired when we bought a company called TrueTac last year. So if you run 1 or more trucks in your fleet, trucks being over 3.5 tons, you have to have an operator's license, and the operator's license obligates you to ensure that you maintain those vehicles and trailers, and also that you ensure that drivers driving those vehicles abide by the working hours regulations for truck drivers. And you need to be able to evidence all of that information so that when you are audited by the DVSA, you can show that you are compliant. If you're not compliant, then they can actually just take away your license and stop your business dead in the water. So it's very, very important that you have all of that information regarding your compliance. So that's our fleet compliance product. We then have a fleet safety group of modules. This includes cameras. If you are driving a truck into London, as of a few months ago, you have to have left and right side cameras to make sure that you don't hit cyclists or pedestrians when you're turning a truck left or right. And we link that camera module into our incident data recorder. So it's very much like a black box that you have on an airplane. It records everything that happened before, during, and after any kind of incident. In this group, we also have a bridge strike avoidance application. There are approximately 5 bridge strikes a day on the UK roads. That's lorries trying to get under bridges for which the lorry is too high. And again, we have a module that provides warning messages when a driver is approaching a bridge that vehicle can't actually fit under. We also have panic alarms and other door sensors. So a variety of different modules, all aimed towards fleet safety. Our next group is planning and optimization. So if you have 5 trucks in your fleet, then actually organizing the workload, what orders are going to be delivered by which truck, which driver is going to operate that truck to meet his driving hours regulations and the remaining time that he has, what route that truck is going to take to make sure that they deliver within the prescribed windows for delivery. All of that can be done generally by hand. If you've got 500 vehicles or 5,000 vehicles, that's an amazingly more complex problem to solve. And we have a suite of software here that doesn't just plan all of that work, but then it optimizes it so that you're using the least amount of vehicles and the least amount of drivers and driving time, and of course that you're traveling the shortest distances to reduce and minimize fuel usage. This product was developed in conjunction with Nottingham University. We own all the IP for it, but it's designed to operate 100% in the cloud, so it can benefit from huge amounts of compute resources and therefore can come up with these plans far faster than the competition. Once you have a plan and you know how you're scheduling the work, you then actually have to execute that plan. And again, once vehicles go on the roads, lots of things can go wrong. Vehicles can break down, they can get stuck in traffic, you can get delayed for a variety of reasons to your delivery. Customers can reject orders for whatever reason. So there's lots of things that can go wrong once you actually start delivering things. And again, we have a suite of software here that allows you to automate all of those activities and actions that you have to take when things don't go according to plan. This is to make sure that you're able to do all of those things to ensure that you're communicating effectively to your end customer and that you're maintaining that high visibility of what's going on, and also ensuring a great level of customer service to the end customer. In order to be able to do that, you need to be able to talk to drivers, or at least communicate with drivers. And here we have our last grouping, driver connected mobility. So we have our own range of hardware as well as third-party hardware, and again a suite of software that manages everything that the driver does from start of shift through to end of shift. So all his satellite navigation requirements, all the information about where he's got to go and what he's got to deliver, checking the items that are being delivered in the right place at the right time, and of course also meeting all of those health and safety requirements to ensure that he's able to read and confirm all of the health and safety notes for any new site that he may drive his truck onto or operate on. And what we often find is that customers tend to buy one or two of these products or groups of products when they first become a MICROLISE customer. So very often customers start at either on the left hand side with fleet performance, or on the right hand side with driver connected mobility. And then we have a dedicated team of sales and account managers that work with our customers to actually upsell new products. And we often find that nearly over 90% of our revenue in any year is actually driven not just by our SaaS revenue, but also by upselling new products and services to our existing customer base. So the kind of benefits that customers can hope to achieve by using our products and services, well, starting from the top left, by planning and optimizing, they can reduce the actual mileage that the vehicles travel. We have a suite of software through our telematics programs that allow us to help drivers improve the way they drive vehicles. We measure over 21 different aspects of driving and provide tailored feedback to drivers to help them improve the way that they drive. And both of those things help to reduce the fuel that's used, and that, of course, that helps to reduce emissions. And it's those things that really help us achieve the green economy mark, which we were awarded when we listed on AIM. Of course, if you're driving less and you're driving vehicles better, then you reduce the wear and tear on the vehicle, so that reduces your maintenance costs. You also actually reduce accidents and incidents because drivers are driving with far more awareness and pre-planning of where they're going. And of course, by reducing accidents, you also reduce the insurance premiums. But generally, what we're trying to do and what we're helping our customers do is improve that fleet efficiency and utilization, really enabling them to do more work, deliver more orders with the same numbers of vehicles and the same number of drivers. Everything is done in real time, and so by digitization, we eliminate a lot of that paperwork, and that real-time visibility of what's going on throughout an operation is extended out to customers, to the end customer, as well as to supply chain partners as well. So everybody gets a real-time view of exactly what's going on throughout that transport operation, and that helps our customers deliver an enhanced customer experience to their end customers. So our software is already global in the sense that we monitor and manage assets around the world. In fact, we are in every single country around the world, including Greenland, including Antarctica, even. So we have assets in every country around the world apart from North Korea. But we only have 4 offices around the world. So we are based in the UK. Our headquarters are in Nottingham, and roughly about 420 staff work there. We have a development and support office in Pune in India, and we have about 150 staff there. And then we have 2 sales offices, one in Melbourne in Australia, and again, another one in Marseille in France. And those are sales offices, so they are generally just salespeople and project implementation and support people. To give you an idea of the market sizes in each of those areas, the UK is about 500,000 registered vehicles, trucks in this case. France is roughly the same size, and Australia is actually slightly bigger, about 640,000 trucks. If you look at our statutory accounts, you'll find that 90% of our business is classed as UK business. Now, it's a bit of a misconception, really, because a lot of the business that we do is with a number of international organizations that happen to be in the UK. So it shows up as a UK transaction, even though we're supplying around the world. So, for example, we sell to Tesco at Tesco group level, but we actually deployed our systems in Thailand, Malaysia, all throughout Central Europe, including Hungary and so on. And similarly, we also supply to Carlsberg, and Carlsberg is deployed all throughout Europe. One of our largest customers is JCB, and again, that's classed as a UK transaction, although we're in about 190 countries with JCB. So when it comes to direct customers, most of our direct customers are UK based, and hence why you get that figure in our stat accounts. But we do have direct customers in France and in Australia, and this is where we see a lot of future growth occurring as we expand our footprint in those regions. So just to give you some highlights of the 12-month trading period that we announced a week or so ago. So we won over 50 new customers, and again, that was a range of customers, including customers with 500 plus vehicles, as well as smaller customers, but a good range of customers across a whole range of industry sectors. Our share of the grocery retail market, as mentioned earlier on, is at 88%. And to give you an idea of how many assets we monitor around the world, that grew by 11%. So good growth, even through quite a difficult and challenging period. We launched a number of products. This is just 2 or 3 of them. So we launched our trailer brake performance monitoring solution. So this is a solution to help our customers monitor the brakes on trailers and ensure that we catch any failure modes before the brakes actually fail. And this is our first bit of AI and machine learning software that we've introduced into our portfolio. We also, through our acquisition TrueTac, we also launched a number of software solutions for the passenger transport market, so buses and coaches. And of course, we continue to enhance all across our portfolio. So our ClearVision camera solution, as well as our planning and optimization solution, all added more features over that period. Of course, post that period, we IPO'd in late July, and shortly after the IPO, we also announced our 4th renewal of our contract with JCB. So this contract now renewed and runs through to June 2026. And just to give you an idea, JCB machines that are manufactured in June will have a 5-year contract, which means that we will continue to see revenue from those machines all the way through to June 2031. So real long-term visibility of future revenues there. Some highlights as far as numbers are concerned, and Bill will go into these in a bit more detail later on, but our revenue grew by 14% to 57 million. Recurring revenue grew by 10% to 35.1 million. EBITDA grew by over a third to 7.6 million. Operating profit grew by 159% to 3.1 million, and PBT grew by 214% to 2.2 million. Cash remained roughly the same at around 10 million. So to give you an idea about market outlook, so there are some headwinds in the market in general. Driver shortages, you can't watch the news without hearing about this. Having said that, this is not something that's new to us. This has been around for years. It has got a lot worse recently and has impacted a number of businesses and a number of supply chains. But the driver shortage continues to be something that a lot of our customers face on a day-to-day basis. The other issue is materials, particularly in terms of chip shortages. That's slowing down new hardware production and new hardware sales to our customers, but it's not stopping us. And both of these things, although these are headwinds, these are issues that we've been living with for about 8-9 months now, and so we are covering them in this presentation only to say that we are aware of these issues. They are headwinds. However, it's not changing any of our forecasts or expectations for our end of year results in December 21, because we've already been living through these for the last 6-9 months, and we've catered for these issues as part of our forecasts anyway. On a more positive note, home shopping and e-commerce is an area that grew significantly over COVID. It has no signs of drawing back. We continue to see increases in home shopping and e-commerce, and again, very positive for us in that it driving more requirements from our customers to be able to deliver more goods, greater volumes of orders, and to be able to do them quicker and to do them for lower cost, and again, without impacting their emissions. So all of those things is really what our products is all about. Brexit also happened, but apart from creating some bureaucracy and paperwork requirements from our customer base, it hasn't really had any other impact. Again, Brexit has meant that there's been a shortage of drivers, particularly EU drivers, but again, has no real impact on us at all. So to be absolutely clear, we're still very positive, and we have a very positive outlook going forwards, and none of the news, etc., that you'll have seen in the press has had any impact on our forecasts or expectations going forwards. I'm going to hand across to Bill now to cover some of the financial highlights.
Thanks, Nadeem. I'd like to start, guys, just by talking about our gross margins, year-on-year comparisons. We actually view our revenue and gross margin internally as either non-recurring or recurring. In this context, non-recurring is hardware primarily, but we also have services, and these are onboarding services such as project management, any bespoke development, plus installation work, commissioning of vehicles, that sort of thing. And just year on year there, you'll see in the blue, our recurring gross margin grew from 73% to 77%. And in this context, our cost of sales is things like external hosting costs, mapping, and airtime. And we're on a trajectory on a gross margin enhancement program, and this is part of that. You'll see, these 4 base point improvements is all about where we're renegotiating some of our relationships and really driving through some benefit. Our non-recurring in the amber there, which as I say is primarily hardware, fell by 3 base points in a year, and that was as a consequence of us having to pay some premium pricing for some of those component shortages that Nadeem referred to. However, overall, as you see in the black, our gross margin overall grew from 57% to 58%. We are a SaaS business, and hardware is an enabler, so a lot of what we look at internally is that recurring revenue. And this is just a chart just to show how our year-on-year growth has moved. FY21, our recurring software grew 10%. However, what's not shown there, in FY20, our year-on-year recurring revenue growth was actually 19%. And 19% is more typical of where we see the business and where the business has been in the past. However, COVID, especially people like JCB who had factory closures, just affected us last year. However, from an ARR perspective, our recurring revenue as at the end of June 20 was 29.7 million. Our ARR as at the end of June 21 was 36.6. So we'd actually seen a 23.3% expansion in our ARR. So whilst that's not necessarily shown here, you'll see that coming through in future years. And also in the RNS, we mentioned one of our customers being Clipper Logistics PLC. That's a significant contract for us, and they come on fairly late on, so that's not really in any of these numbers at the moment. P&L, Nadeem mentioned, we grew our revenue 7 million to 57. That delivered us an EBITDA of 7.6. You'll see there how we split the revenue. 38% of our revenue this year just ending was non-recurring. I say primarily hardware, and 62% was non-recurring. However, 83% of our gross margin was recurring revenue. And point to note, in admin expenses, there is our R&D expense. Traditionally, when we were reporting on the UK GAAP, we never capitalized any R&D expenses. So all of that has just been historically expensed year on year. Now we've obviously implemented the international accounting standards. We do have to capitalize some software, but we do spend a considerable amount. We spend probably 7 to 8 million a year. However, our auditors only allow us to kind of record on the face of our accounts those R&D expenses that are subject to the R&D tax credit systems, and therefore we show normally around 5.5 million. However, 7.5 point I just want to make on the 7.6 EBITDA as part of the roadshow, and I mentioned in the other slide, margin enhancement is something that's got a lot of focus on our business. And I did report to prospective investors that I have a target to kind of grow from our FY20 5.5, which was at 11% EBITDA level, to kind of 15 to 20 over the next 18 months to 3 years. The year just ended is, despite the premium prices we paid on hardware, was 13.3. So we are on that trajectory, and we'll see more of that in the future. Our balance sheet, just wanted to highlight a couple of points here. One, you'll see at the top there, intangible assets at 76 million, just to give you some comfort around that. The bulk of that, some 72 million of that figure, was internally generated. Back in September 2018, I introduced a new top co over the business, and that was to enable me, and it acted as the vehicle to enable me to do some share buyback, in obviously preparation for the IPO, and also to facilitate some plans that our shareholders had who were looking to exit at that point. So that enabled me to do that. So it's all our historic performance obviously moved up into intangible assets. Other couple of points to note, you'll see our trade and other payables, both current and non-current, is quite significant. Just so you don't get alarmed by that, the bulk of that is non-cash. It's actually deferred income from companies like JCB who pay us up front. And I think there's been some confusion with investors when I've said that. So just to explain what I mean by upfront, we invoice JCB each month for the machines they've manufactured and deployed our solutions to. We invoice them both for the hardware that's gone on those machines and also for the recurring revenue contract aspect. That recurring revenue aspect is typically 5 years. So we'll invoice the hardware and we'll then recognize that hardware as non-recurring. We'll then invoice them the full 5-year term for that contract. And we'll defer 59/60ths of that into the deferred income, and we'll recognise 1 month as we move through the contract. So we generate quite a lot of cash, which support the business's working capital up to this point. And as I say, that's where it's recorded. So please don't be alarmed by that. Another point I just wanted to note, as part of the roadshow, I did mention, which comes back to this top co I introduced in September 18. You'll see there at the bottom a merger reserve of 55 million. And I mentioned on the roadshow I wanted to move that into distributable income. And that's what we've done. So you'll see that's now moved into retained earnings. That's because at some point in the future, we do want to start to look at issuing dividends. That's not on the plans in the near term, because the whole purpose of the IPO was to raise funds for M&A. So we want to go through that program before we consider it. But the business is very cash generative. So at an appropriate point, we will look to consider that. From a cash flow perspective, as Nadine mentioned, at the end of this year, which is obviously just before the IPO, our cash was similar, around 10 million. However, you'll see at the top there, cash generated from operations actually fell from 8.9 to 6.9. Again, just so none of you guys get alarmed by that. That all relates to a timing issue. Our largest customer had done some changes to their product codes, and we agreed with that as part of the contract renewal. We simplify some of our product codes. So we've done that, and we invoiced the customer using those new product codes. But there was a bit of an issue where they hadn't quite amended the back end of their SAP system to accommodate that. So their system basically kicked out all our invoices because they didn't match. So that's what that relates to. It's not a performance issue, it's purely timing. And to add a few weeks after year end, all those invoices have been paid. So when we come to our December results, which will be for the full year, but it will be 18 months, you'll see that back into normal kilt. And just to bring everyone up to date with where we are post IPO, we raised, as Nadine mentioned, 18.6 million of new money on the market, net of costs, and combined with the money we had in our bank. We've actually used that to pay down all our debt in the business, with the exception of the final deferred payment due to the former shareholders of TrueTac, which is due next March, and that's £1 million. So other than that, all the debt in the business has been paid down, and we have currently circa around 10 million in the bank. And I also have a 20 million committed RCF facility with HSBC. hence why I paid down all the debt, because I can take it back quite straightforwardly if there's M&A to facilitate. And we are looking at currently, despite the distraction of the IPO moving straight to the results process, that hasn't stopped us looking at M&A. And we're currently going through, as you can imagine, it's a funnel. We're qualifying in and qualifying out opportunities. We've also asked our teams in Australia and France, who know their geography obviously far better than us, to produce a wish list who they would like us to acquire. And we've received that list and we're currently moving through. So whilst I've nothing imminent I'll be announcing to the market on M&A, activity is progressing at pace. And this time next year, me and Nadeem would be bitterly disappointed if there wasn't one, if not two, M&A opportunities that we'll have completed and integrated into the business. So that's a real high level tour of our numbers. I'll pass you back to Nadeem.
Okay, so just to give you an idea about the market and where we are in the market. So if you look at this slide, it shows you a number of the companies that you may have heard of in the international landscape for this type of solution. But interestingly enough, there are companies here like Quartix, which is another AIM-listed business. I mean, Quartix, for example, do a lot of products in that fleet performance segment, but they don't do anything in fleet compliance. Similarly, you have companies like Ortec or Descartes that do a lot of work in planning and optimization, but again, they don't do anything in fleet performance. So what we find when we look across the landscape is there are lots of companies that do bits of what we do, but there really isn't anyone that does all of the different things that we do. And this is really what helps us win customers, is because they can come to us and buy a suite of solutions that covers all of their operational needs, and that is seamlessly integrated together, or they can buy point solutions from 3 or 4 or 5 different players and try to work really hard to try and make them all link up and work together. And that's really the reason why we win a lot of our customers, is because they recognize that they can have that one all-encompassing solution that covers everything that they need to do. In terms of our market position, since our IPO, we continue to be very confident in our end-to-end offering. There's been no real changes in the competitive landscape over the last few months. And as Bill mentioned, we are looking at M&A activities, as well as putting significant investment into continuing to develop products in-house as well. We have a very clear growth strategy. So we have lots of large existing customers who continue to get bigger, particularly in times like this. A lot of the smaller players don't survive and are swallowed up by some of our larger existing customers. Our larger existing customers are also being driven by things like e-commerce. So, our customers include DPD and Yodel, for example, who are growing, as well as Royal Mail, who are growing because of that boom in e-commerce. So we have structural growth that's helping us grow revenue from our existing customers. We also upsell new modules and new products to our existing customers, and generally over a period of time, our revenue generated from existing customers grows as they buy and take on board new products and solutions from our portfolio. Doesn't mean we stand still. We still acquire new customers, and again, over the last 12-month period, we acquired 50 new customers, both UK and international. And although we have this very dominant market share in large fleets, we also have solutions for smaller fleets as well. And even in that sort of sub 100 vehicle fleet segment, we have a 22% market share. So we are continuing to grow across all of those different segments. So organic growth is important to us, and over the last 10 years, we've grown by 400% just organically. But the key reason why we came to market was to help us raise funds for M&A. And we have some very clear view of the kind of targets we're looking for. So we're looking for targets that can add to our product portfolio, so we can cross-sell into our existing customer base and also sell our portfolio into the target company's own customer base, and targets that can help us grow our geographic footprint. And so a lot of our customers, our direct customers, are in the UK, and really we want to grow that internationally and trying to replicate that huge market share that we have in the UK, doing that in other geographies. So we are really looking for companies that meet those two criteria for acquisition. So just to summarize, we've talked about a number of headwinds. However, despite that, we are confident of meeting our market expectations for our next period through to December 2021. Longer term, we're still very confident in our portfolio and in our operating model, and we see that there are other forces that will continue to push our market segment to be able to do more, to deliver it faster, to deliver it more cheaply. And again, that's what our portfolio is aligned to do. So very confident about our future as a business. And of course, also important to note that I didn't sell any of my shares as part of the IPO, and I continue to be the largest majority shareholder within the business. And part of the reason for that is because I personally am very confident in the future of this business and where it's going. So that's the summary. So I'll hand back over to our hosts.
Fantastic. Nadeem, Bill, thank you very much indeed for a great presentation. Thank you for that. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Nadeem, Bill, before we go on to the live questions, we've had quite a few come through. We did have a couple of pre-submitted questions. If I may just read out the first one. It reads as follows: you have a dominant market share in your core fleet market. Please could you highlight the optionality of the business outside of this and where you intend to allocate capital?
Okay, so you're absolutely right. We do have a very dominant position in the UK, but we see that we've still got growth to happen in some of the smaller fleet segments, and again, we are growing in that space with some parts of our portfolio that's been tailored more towards that smaller fleet segment. And of course, international growth is where we see our biggest opportunity. We're trying to replicate that market share opportunity, the market share that we've got in the UK, and trying to do that in other geographies, particularly in France and in Australia. So we still see lots of growth still to come in all of those areas.
Fantastic. Thank you very much. The next one reads as follows: what are the plans for your JV with Zebra Technologies? How much will it move the needle?
Okay, well, I think there's some confusion here because we don't have a JV with Zebra Technologies. We are one of a number of resellers of Zebra hardware, as well as obviously supplying our own hardware too. So I'm not quite sure where that particular question has come from, but there is no JV with Zebra.
Thanks for clearing that one up. And the last one we have here is, it seems that you run your SaaS platform. How is it provided, as a colo or fully in-house? And given you wish to expand to other geographics, how will this have the flexibility to support wider geographies and their differing data and security regulations?
Okay, so yes, we operate out of 2 data centers, one in East London, one in West London. They are co-locations, so we hire the suite, but all of the hardware and equipment belongs to us, and of course we're responsible for maintaining and supporting all of that. Having said all that, we do also have some of our applications run in AWS as well as Azure. And overall we're fairly agnostic. We operate a lot of applications on our own data centers because that's the most cost-effective way of doing it. Equally, there are some applications that run in other cloud providers because they're more appropriate to do that in those environments. We have, as I say, 2 of our own data centers as well as access for AWS and Azure. So we have a very strong position as far as DR and disaster recovery is concerned, and resilience. And of course, we meet all the different security standards that are required by our customers. We are an ISO 27001 accredited business, and we also do a lot of work in the government sector and military sector. So again, security is quite key and important in all of those areas too.
Fantastic, thank you, Nadeem. If I may, guys, just ask you to click on the Q&A tab, and just where appropriate to do so, perhaps we can start at the top and work your way through. Just read out the question, even who it's from, and give your response. That'd be great. Thank you.
Okay, so the first question was from Andrew G. That says, do you lose market share to Blue Yonder, Illuminate Transportation? How do you position against it? Well, actually, in the UK, certainly our market share continues to grow. We have that very low churn rate of sub 1%, so we're not really giving away market share at all. And generally, we compete with businesses in very much the same way. We have an extensive portfolio that covers all of the operational needs of our customers, and it's seamlessly integrated, so they, through one window onto their operation, they can see everything that's going on in real time. So hopefully that covers it. The next question is from Andrew C. It says, can you say a little bit more about the move to electric vehicles? You're doing a lot of area engineering to your solutions for vehicle diagnostics and driver behavior, and could the move to electric damage the company's opportunities? Well, it's fair to say we've actually been involved with electric vehicles for about 8 years. So it's by no means anything new. We have lots of customers that have electric vehicles. And the other important thing is that we don't just operate with electric vehicles and diesel vehicles. We also have customers that operate with gas vehicles, LNG and CNG gas, as well as hydrogen too. So we've been involved with a number of trials over a number of years, looking at all sorts of different types of fuel technologies. And our software already supports a number of those technologies. So it's not something that we're afraid of. In fact, we wholeheartedly embrace it because it's all part of the work that the industry needs to do to move away from fossil fuels and help reduce greenhouse gas emissions. Next question from Thierry is, what will be the impact on your business of the move away from fuel? And I think we've answered that question as well. We only see those as positive things, and in fact we already support a lot of those alternative fuels. So again, we don't really see that as an issue for our business. Could you comment? Next question is from Andrew C. Could you comment about acquisition opportunities? Is this an important driver for growth? And what might they look like? Well, I'm hopefully answered that question in the earlier slide that says that really we're looking for companies that provide complementary products and technology that will enhance our portfolio and that will enable us to sell that into our existing customer base. That's the kind of the businesses that we are looking for. And yes, generally the idea is that it should be fairly transformative in terms of size. The next question from Sat P says, when customer buys new trucks or when you acquire a new customer, do you send out your own engineers to install the kits in the trucks, or do customers install the kit themselves? Generally, it falls into 3 groups. So we have OEM customers, people that make vehicles, and they tend to install our equipment directly on the production line. So again, we're supplying just in time for production line fitment. We have other customers that fit it themselves. So these are what are called bodybuilders that are there, that take vehicles and actually change the frame or add other sensors or other equipment on before delivery to the customer. So a number of our large customers actually order vehicles from their dealers or suppliers with our equipment as part of the specification. So we supply to the dealer, who then installs it and delivers it to the end customer. And then thirdly, where we are supplying equipment solutions to fleets that already have, where the vehicles are already in situ, again, the majority of those installations are carried out by our own engineers. Where there are peaks in demand, we do subcontract that to third parties, but approximately 70% of those installations are done by our own engineers. Next question from Donald G about Eurowag is currently undertaking an IPO. Are they a competitor? The short answer is no. We've never come across. We know of Eurowag, and I know of Eurowag certainly, but they're not a competitor. We have never competed against them in any bid that we've done that I know of in the last 7-8 years. It's another business that operates in the same kind of market segment, and we also, as MICROLISE, we also have integrations with a number of other fuel card companies and another of the providers in that fuel card space. But no, we don't see them as competitors. Next question from Andrew G. Running a data center in London must be expensive due to the high cost of land and electricity. Do you consider cheaper alternatives? Actually, it's not that expensive. And part of the reason to run it in London is for the connectivity. Remember that we're integrating to systems worldwide. And by operating through London, we have access to some very fast connectivity all around the world, and so that's the other good reason for operating in London. And it's not significantly more expensive for us. And the last question from Damien C says, now that software development costs are to be capitalized over, what period will you amortize these costs? Well, we aren't really. Our policy regarding capitalization of software development remains the same. We are going to have to do some capitalization because we've obviously now moved to the IFRS standard, and hence that means that there will be some capitalization that happens. But I'm gonna see whether Bill wants to answer that question in any more detail.
Sure. Our auditors are constantly on our back because they want us to capitalise a lot more. We've resisted it thus far, but it is an agenda item, so it may well be something we do in the future that goes beyond simply the requirements of the international standards. But at the moment, we're just doing the minimum of what we need to do, and we'll look to amortise that over a 3 to 4 year period. We're still working that through with our auditors, but it certainly won't go beyond that kind of time frame.
Okay. Well, that's it. Nadeem, Bill, thank you. You've answered every single question we've had through. So thank you very much. And thank you for the attendees for submitting them. If there are any further questions that do come through, of course, you will have the ability to review those post-event as well. And just on that basis, Nadeem, perhaps I could ask you for a closing snapshot before I redirect investors to give you some feedback, please.
Sure. Thank you. So to summarise, we've produced some interim results here that we think are pretty good given the actual 12-month period that they cover. There's been challenges with multiple lockdowns, furlough, the COVID pingdemic, as well as Brexit. And thanks to all of our staff who have been working diligently throughout that period, as we've managed to produce some great results and continue to show growth, both top line and bottom line. And I think we're well positioned for continuing that trajectory going forward. So thank you very much for your time, everyone.
Thank you.
Fantastic. Nadeem, Bill, thanks again for updating investors today. Could I please ask investors not to close the session, which will be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of MICROLISE Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon.